Certain economic professionals are calling for a soft landing with Federal Reserve rate reductions taking place just around the corner. We're going to talk about exactly what that means, how that's impactful, and what's going on in the market today.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
As of late, there's more and more buzz about the idea that the U.S. economy may in fact be able to pull off a soft landing and avoid a recession. In fact, there's actually interest rate cuts potentially on the horizon in 2024. We're going to talk about this here today on the Trend Report. And as usual, we will dive into data to show the impact of all things related to the economy and finances in the market and politics as they're affecting the stock markets and bond markets as we see them today. So with that being said, let's jump right in. Now, as you know, the inflation rate has been coming down. We hit a high in the 9% range over here back in 2022. And inflation has been dropping. It is currently coming in at 3.2% for October of 2023. But what a lot of people are still talking about is this cost of living squeeze that has hit Americans very, very very hard, I should say. And in doing so, I think a lot of people seem to misunderstand the kind of the basics of inflation. So I won't spend a ton of time on this, but I think it's worthy of pointing out. So when you're seeing this particular article was in Bloomberg, but when you're seeing that they're saying that electricity is up 25% and going out to restaurants is up 24% and groceries right here are up 25% and some of these other items here, rent up 20% and so on and so forth. And people are saying, well, wait a second, but the inflation rate is only up right now 3.2%. Well, no, what that really is inflation is currently running at 3.2%. So back here, going from 2020 up to 2022, these inflation numbers were increasing. And so these costs of these items, the cost of living is going higher and higher each time as this inflation rate is going up. Now, the inflation rate is still going up. It's just going up by 3.2% rather than by 9% when it hit its peak. But unless you see this line get down below zero and actually go negative, it only reduces costs when it goes negative. Otherwise, it's just reducing the speed at how the costs are going up whenever the number is in positive territory. So hopefully that makes sense. But that is why you're seeing so much publicity being put on the fact that the average American is paying significantly more for certain goods and services. And also, there are pockets within inflation. Some things were not impacted very much by inflation. Other things were impacted very heavily. And obviously, in an article like this on the left-hand side of the screen, in an article like that, they're cherry picking some of the very highly impacted items from inflation. Excuse me. Now here, we want to talk about what's being projected forward as potential for reduction in interest rates from the Federal Reserve. And this is actually an article from the Wall Street Journal on November 27, showing expectations going into 2024. And they're showing that, here we are at the 5.3 to 5.4% range, and then they see them dropping down potentially to about the 4.5% range by the end of 2024. Now, that's yet to be seen, but what they're doing is they're basing that on what are called interest rate swaps. And that's kind of essentially people betting on the future of interest rates. So kind of like you can go long or short on a stock. This is a way for people to identify, or investors to identify, whether they'd like to invest on rates going up or rates going down. And they're basically saying that people are betting on the fact that these interest rates are going down. Now, that coincides with some discussions we've had before about the fact that the Federal Reserve has been pretty open about the fact that they wanted to increase unemployment. And that sounds counterintuitive, but the concept is that in order to cool off interest rates and cool off inflation, they have to increase the unemployment rate. Now, if we go back to prior to 2020, you can see the huge spike in unemployment that took place. We got up into the 15% range here when everything hit the fan on the pandemic, and it's been steadily coming down, but it's been a long road. Today, the unemployment rate is at 3.9%. It has actually increased because the unemployment rate, it's hard to see on this chart when it's, dealing with such minute changes, but down in here, it was down in like the mid threes. I believe it hit like 3.3, 3.4%, if I remember correctly. And so now it's slowly eked its way back up, and it's at 3.9%. But as the old saying goes, 4% of the people out there simply don't want to work. So many economists will argue that if you are at about 4% or below on unemployment, that you really are fully employed, because there's just a certain percentage of people who are not going to work no matter what we do for them. And so this is a very strong number, even though it increased a little bit on the unemployment. It's a very strong number. But at the same time, we are seeing, if we go back a screen, we are seeing inflation coming down. So therein lies the theory that we can start to see a dropping off of these interest rates. We can see the elusive soft landing for the economy. Now, as all of this is taking place, the market has gotten extremely volatile. So it was volatile before the pandemic. It is ultra volatile since the pandemic. And that introduces the fact that a lot of people who in the past had not been concerned with risk management have become very concerned with risk management, because they don't want to be on such a roller coaster ride, at least the volatility of getting hit with, a lost decade like we had during the financial crisis and things of that sort. And what's happening right now is there are a lot of investment choices out there, and they're growing rapidly. They're growing very rapidly because it's an increase primarily in managed investment products. And the reason those managed investment products are important is because, generally speaking, if they're being managed for not only selection of the investments, but also the risk management of the investments that are being held. And these are things that most investors could never pull off on their own. So they need these managed investment products that are being managed by professional asset managers, just like all the professional asset managers that work off the backbone of USA Financial Exchange, which is where likely, if you're listening to this video, you probably have accounts that are invested there. This is showing basically the rapid increase in need for assistance with financial advisors. So today, if you bring this across, they're saying there's basically about 725 to 750,000 different managed investment products, and they're calling for it to hit 1 million in about 10 years, at about 3033, it looks like here on this particular chart. Now, equally important, the reason I kind of showed this as well, is people are finding that there are 3 areas that they're getting their best information from. They're getting their best information from professional financial advisors. They're getting their best information from investment or trading platforms like USA Financial Exchange. And they're getting their best information from various financial websites, many of which are run by these 2. And then down here, they're saying that even people who do not work with a financial advisor, 31% of them are saying that they find advisors to extremely valuable. Now, if somebody is working with an asset manager, 90% of those people feel that their advisor is extremely valuable. So only 10% of the people who have a financial advisor don't think that financial advisor is extremely and or very valuable. So I think that shows the great need for all that's out there, because this is becoming a very complex world, and the financial advisor is becoming a true advocate for the investor in this complex environment that we're in. So we always embrace that relationship. Anything we can do to help you and support you in the relationship you have with your portfolios and with your financial advisors is why we exist in the first place. Now, with that being said, let's take a look about what's going on in the markets per se right now. So from a capitalization standpoint, looking over the last 12 months of history here, what we're seeing is the overall stock market is coming right around in the middle here. We're ranking this based on the trend. The trend is this lower graphic down here. We're just going numerically, and as you can see, the overall market is in the middle. So what this is telling us is that these are the subsets of capitalization that are really kind of buoying and lifting the market. So it tends to be all the large caps. The S&P 100, the Dow Jones, the S&P 500, QQQ is the NASDAQ 100. So all large cap oriented indexes. And that's really what's kind of driving the market more so today. Right now, it's the small caps and mid caps that tend to be down here at the bottom. Look at all the mid cap 400 variations, the small cap 600 variations, as well as the Russell 2000, which is essentially small caps as well. Over here, we are seeing on the graphic, we are running above, this is the 200-day line, so we're running above that line. We are in the zone, so to speak, with this uptick in green. We're also seeing our swing has turned green, and if you look right there, it looks the trend itself has turned green. So everything up here is showing that the trend, the shorter-term swing, as well as the shorter-term zone are all lined up as being bullish on the green, as opposed to reddish on the bear. If we take a look at the similar market, but from a sector slice and dice viewpoint, what we're seeing is the equally weighted sector is going through some of the same motions as the overall market. We've got this upswing for the zone and the swing. We're seeing just a touch of green starting here on the trend down here in the bottom. And what's really driving things is information tech, financials, and then we do also throw into sectors just so you can track it. We've got gold and silver in there, and they're both driving at the upper side as well. What's pulling things down are energy, healthcare, and consumer staples down in the lower end here. And then if we look at international equity, notice how everything turned green. Now, if we went back a few months, you saw the opposite. You saw the U.S. was driving all the bullish trends, and it was the international that was lagging behind. Now it's starting to flip a little bit. Not that we're not seeing some good bullish short-term indicators here at the U.S., but we're seeing also the trend, the long-term, all the way across the board on the international. Here in the middle, we're getting this big swing up that we've talked about. We just peaked over the 200-day moving average right there, but we've got good swing. We're in the zone with these green dots, and we've also got the trend hitting in the green now as well. So very interesting to see that everything is in unity. We've got green dots all the way across the trends, the swings, and the zone are these green lines here as well. One thing I could have mentioned on each of the previous slides also is right here, these black, that is the support line. This is the resistance line. And as you can see, we broke above that resistance line, and we'll continue to track until we reestablish new support and resistance numerics there as well. And then finally, in the bond environment, the overall bond market is coming in just below zero, showing still red on trend, but we are getting green on the swing and the zone. So we're getting this uptick. But as you can see, we're still running below the 200-day moving average. That's this line running through here. So we've got a long-term downtrend that's starting here and bringing it down, and it's working its way back up. Back up to the zero line So it's about to hopefully turn the corner if all goes well. And most notably, you'll see quite a mixture of different bond styles up here. But what jumps out is really the bottom of this sheet. We're seeing all of the U.S. Treasuries are what are kind of dragging down the overall bond market. So lots of things going on. We will continue to address and watch this moving forward. But we are seeing quite a bullish short-term trend in the equity markets, and the bond markets as well seem to be rebounding. And again, you don't always see that. You don't always see the equities and the bonds moving in the same direction. But right now, essentially, they are.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.